Hi folks. I wanted to start this show called At Home with Jeff for actually a couple of simple reasons. I'm in the finance industry and I deal with consumers a lot during the course of a week. There seems to be a bit of an issue when it comes to information. One of the reasons I wanted to do this show was it was two reasons actually. One was to educate and the other one was to prepare. There's a significant amount of people who own homes, and there's been a large group of people who have lost homes over the last several years. My idea behind this show was essentially to try and get those people to understand better financially where they are and what they should be doing when it comes to financing a home, and that's whether they're refinancing it or buying a new home. Two topics I wanted to talk about tonight. One of them had to do with credit reporting. Now, this is a major issue. In fact, a couple of weeks ago, there was a show with CBS that talked about the issues having to do with discrepancies on credit reporting. And in fact, some of the details that they talked about were just staggering. One key example, they talked about over 40 million people, 40 million consumers have mistakes on their credit report. And of that 40 million, over 20 million have significant mistakes. Now, that's a major issue. Now, getting these mistakes cleared can also be a major problem. And so I wanted to talk to you tonight about some of the things that you can do to clear up these items and to be prepared for dealing with these items. Now, one thing that most people don't understand as a consumer is you have the right on an annual basis once a year to get a copy of your credit report from the three major repositories. Now, the repositories are Equifax, Experian, and TransUnion. Now, there is a website you can go to. I believe it's called annualcreditreport.com. It allows you to actually pull a copy of your credit report. Again, you can only do that once a year. The information that's provided to you allows you to have an idea of who your creditors are, if you've ever been late, what the outstanding balances are, your monthly payments. Now, why is that important? Well, with the amount of credit reports that I see on a weekly basis, you'd be surprised how many of them have issues or problems or discrepancies. Now, you would think it would be very easy to correct those mistakes, but it's not. So what's most important is that you are educated as to how to deal with these and prepared as to how to resolve them. So by pulling that credit report, it gives you an advantage to know exactly what to expect before you go refinance your home, or if you go and get a car loan, or even get a job nowadays. You don't want to have a surprise like that. How would you deal with this? Well, aside from actually pulling that credit report, you'd want to know what's happening before the fact, before you're alarmed at this problem. I always try and tell people you should pull it at least twice a year. Now, you're allowed one free per year, and the credit agencies, they have their own little solutions that you can actually pay for and to get these services. But I'd say on a biannual basis, you should be pulling that credit report and see what's on it. Because if in a situation you had a dispute with a credit company or with a debt, if that went into a collection, collections are very difficult to get removed. They're not impossible, but you have to deal with the debtor or whoever the company was. It could be a dentist, it could be a credit card company, it could be one of the local vendors for your phone company or for electricity. Once they go to collection, again, it becomes a journey, and I want to try and educate you as to what you need to do to resolve it. So let's start with the very beginning. First, you got to get your credit report pulled. And people ask the question, well, is that credit report the same credit report you see? It's not. It's not. It's actually it's a simplified version of what we see in the finance industry. So it's good to get a copy of that because it'll show you, again, what issues you have or what matters you have to deal with, if there are any. Now, you could have a credit report that is, it has no issues with it. It's consistent with what you owe and who you owe. But being able to deal with a problem on your credit report can save you a tremendous amount of money, because if you take into consideration getting a loan and doing a refinance or even buying a home, those discrepancies on your credit report not only could disqualify you from that loan, but could also make a difference as far as what rate you get, an interest rate. You could have someone, as an example, who had a collection, and with collections, most lenders nowadays aren't too keen about giving someone a loan with a collection, and the collection could be as small as $100 or it could be $1,000. It's essentially treated the same. It's a collection. So it's important to be able to resolve that and get that removed as quickly as possible. So what are some of the things you do? Well, again, get the report. Secondly, in that report, it should basically say who the creditor is, how much is owed, and it'll tell you when that issue started, or when you had when the collection was put on, or when you were late, 30 days, or 60 days, or 90 days. Because the longer that you're late, the more of an impact it has on your score. And there's different scoring. Since there are 3 repositories, they each have their own scoring system. The one that's most famous that most people hear about is the FICO scoring. So let's talk about, again, resolving the credit. So you get that credit report, you find out there's a problem with one of those. How do you resolve it? There's a couple different ways you can do it. You obviously want to get in touch with that vendor and let them know exactly what the problem is. You have to make a dispute. Some of the credit agencies or repositories, such as Equifax as an example, have the ability within their system so you can actually make the dispute internally. And then they will contact that creditor directly and try and resolve it. That's one way of doing it. Again, it pays for you to use that service. You can go and do it yourself. You can pay someone to do it, but I always take the very simple approach. And why pay someone else to basically do what you have the ability of doing yourself? So again, just basic conversation. Now, getting in touch with this company, how would you do it? Phone call would be a start. If you're having an issue with it, I always tell people, put it in writing. And what's the easiest way to do that? Well, fax it to them. People will say to me, well, I don't have a fax machine. There are plenty of fax services that are web-based online that you can use to basically fax things. I mean, some of these are as cheap as $5 a month for a couple hundred faxes a month. So it's real cheap to do that. Once you basically make that complaint, then they have a specific amount of time period to resolve that complaint. And if they don't resolve it by a specific time period, then federal law steps in and they can be sanctioned and fined for it. So it's important that basically you document everything. When you contacted them, who you contacted, what phone number, make sure when you talk to them, because a lot of the letters that you may get from a creditor won't have the fax number on it, so make sure you get a fax number. Now, once you get that information, they have a specific time period that they can resolve it. I always try and tell people, keep on top of it. Every other day, contact them for the first week, then they allow them time to resolve it themselves. So I'd say for the first week, contact them possibly 2 to 3 times. You want them to know that you're serious and you want it resolved. You also have to provide documentation. So as an example, if there's a collection that was put on your account, but you paid that collection, or moreover, if that collection had nothing to do with you, or maybe, as an example, I had a recent client who had services done, and she told me that the services were never actually done, but they charged for it. Well, there's a dispute right there. So you need to go back to the original creditor and say, listen, these services were never rendered, or they were rendered and I paid them, and here's proof of a canceled check. So that's how you go about that part of it. So get documentation. Now, after a week's time, what happens? Well, you got to make sure what documentation is necessary from them, that you get to them, and you can also ask them the question, what is it that you need in order to provide this proof? They move pretty slowly, so you have to be patient and at the same time document everything. Okay? Now, once you basically work through that process, you got to find out exactly how quickly they can get it removed. Now, they don't have to remove it. If the collection is in play and it is yours, they could keep it on there essentially for 7 years. So again, be patient. That doesn't mean that they won't. So as an example, if you paid a collection and you have proof of it, based on who you talk to, it's very possible they may remove it from your account. Now, by removing that collection, it will increase your score. And based on who it's with and the matter itself, it could increase your score pretty well. It could go 10, 20, 30 points. Could be even more. So where are the scores themselves? Well, the typical scores run from between 350 to 850. Right now in the finance industry, as far as home finance, usually someone who has a 740 to 760 score is considered A+. The auto industry is a little different. Theirs are in the lower sevens. But from the finance standpoint on refinancing or buying a home, it's in the mid to high sevens. So I've had people ask me, well, I'm in the 800s. What's my score? Well, it's essentially an A+ score. So you can pretty much get yourself the market rates. Again, that's subject to other things such as, the amount of equity you have in the property, how much debt you have in the property, what they call debt-to-income ratios, and the equity portion is what they call loan-to-values. So getting a good interest rate on a mortgage usually takes into play what they call the 3 C's. First one is creditworthiness, is your credit score. Second one is capacity, which is a relationship of income to debt. And the last one is collateral, so loan-to-value, the amount of equity you have in the property. So where you end up seeing someone getting market rates is someone who's done very well with their credit score, around, again, 740, 760, has about 20 to 25% equity in the property, and as far as the debt is concerned, they have about a 35% debt-to-income ratio or less. So that's how we deal with that part of it. Now, getting back to credit scores. The article that was basically done last week with CBS was an amazing article because it brought into light a lot of information, and the idea that it's not very easy once you have an issue on your credit report to get it resolved. So I want to kind of talk with that a bit and see if we can address exactly what it is we can do about resolving that. Again, I brought you through the initial stages. So once we get to a stage and saying have it removed, then we have to actually end up pulling another credit report. And usually if you're working with a bank, they'll do a supplemental, or they may end up reissuing the credit or doing what they call as a rescoring, which means taking into consideration the updated report and find out what the new scores would be that would put you in a better light with the lender to get a better rate. Okay? So some of the things that you have the ability, and now you have the ability of getting that credit report, and there are some other instances where you can get the report pulled as well. One is if you were denied credit, they have to basically provide you with the reasoning why they denied it. Unemployed, if you're unemployed and you're applying for a job within the first 60 days, again, they have to provide you information as to why they were denied. Receiving public assistance, and also if they're reason to believe that your report contains fraud. So those are some reasons why they may provide you with a copy of your credit report aside from the annual report that you can request. Okay. Now, some of the other information that I basically gathered from this report is pretty amazing. One of the things that they brought into light was the idea of not only how difficult it is to basically get a report, but also the issues surrounding the report. As far as who to contact, when to contact them. That's why I gave you that general piece of information as to what specifically to do when it comes to resolving your report, because when you make that request to a creditor and you send the request to the credit agency to get resolved, it may not be a local company or a local agency of the credit reporting agency. It may be a company that, or a part of the agency of Equifax or Experian or TransUnion that is not in the United States. And this is from the CBS report, so it's amazing to hear that information. So that's why it's so important to have your report pulled annually. And from my standpoint, you should pull it at least twice a year. Kind of to give yourself a better understanding of what it is you're dealing with, especially when you could be going for that mortgage, or you could be going for that car loan, or even for a job, and it could sincerely affect it. Now, the other part I wanted to talk about tonight was a program called the HARP program. Now, the reason I wanted to mention that tonight is because it does work along the same topic as credit reports and its credit scores. And the reason for it is this. The HARP program itself was put into play by the government to assist people who are underwater when it comes to the equity in the property. So you had a lot of people getting into programs that were 100% financing, no skin in the game, put the bank in a position where they had higher credits, higher loan-to-values, and equities or values in properties that maybe were overinflated. So the HARP program essentially helps people nowadays, and it was put into play within the last couple of years. So if you are underwater, it will allow you up to 105% of the value of your property. The credit score is based on whether the loan is with Fannie Mae or Freddie Mac, is all based on pulling in what they call an AU, an automated underwriting finding, and determining whether it's with Freddie or Fannie. Now, you can actually find out who your loan is with. The credit report should show it. There are instances where it doesn't. So one of the other places that is easy to find it is actually a website called makinghomeaffordable.gov. It allows you to go on there and find out more information about the HARP program. Certainly you can always contact me at any point in time or us to get more information about it. But quite honestly, the HARP program is a huge advantage because it provides people who maybe are having issues with their credit, or more importantly, people who are underwater who feel that they can't qualify for anything else. Typical government loans will allow up to 95%. They're few and far between, up to 95%, except if you're dealing with a government loan such as an FHA that will allow up to 96.5%. So that's a huge advantage. But with the HARP program, it helps people who are above that threshold so that they can be in a better light to basically help themselves get out of an existing mortgage that has a high interest rate, or unable to refinance through their existing lender because they don't have the equity in the property, or their credit scores aren't, in the best of light, or they've tried to get their loan modified and the lender unfortunately hasn't allowed them to modify the loan. So the HARP program, again, is a huge program that puts people in a better position to get out of a high interest rate on their home and get into something that's certainly a lot more competitive. And people will ask me, well, what type of rates are you talking about? The rates are actually competitive with market rates. And you've got people who are in a program that are at 105% loan to value, and that are able to get into a market rate with someone who's got more equity in their property. So the question comes to light: some of these terms being used, loan to value as an example. Well, give an example. Loan to value is essentially is the equation or the difference between the amount of loan that you're going to take out versus the equity in the property. So as an example, if you're taking an $80,000 loan out on a property that is worth $100,000, that's an 80% loan to value. Okay. Once you go above that 80%, then a lot of banks end up requiring private mortgage insurance. And the reason for the private mortgage insurance is it actually protects the lender in case of a foreclosure, as an example. So when you end up dealing with a conventional loan, 80% is the threshold. You go above that, you're going to end up paying private mortgage insurance. The less skin you have in the game, the higher the mortgage insurance is per month, and you pay that up until the time that you hit an 80% threshold, where most lenders typically say about 78% threshold. And people will ask, well, how do I get out of the private mortgage insurance? You actually have to order an appraisal, and with that appraisal, you basically have to pay for it. When it comes in, it has to meet that 80% or 78% threshold. Once you do that, you can make the request to have the PMI removed. If it doesn't, the PMI stays in play. With FHA, it's a little different. Doing an FHA loan is different than the HARP program. It can tend to be costly, but it also puts you in a good position as far as what you can afford, because it goes up to 96.5%. So when you've got someone, as an example, at $100,000 value of a property, say they're looking to buy a property for $100,000, they can get a loan up to $96,500, and there's an FHA fee as part of that. The fee right now is 1.75% of the loan amount. Now people say, well, that's costly. Yes, it can be, but it's a great government program, and it allows you to take that fee, and instead of paying it out of pocket, you'll end up rolling it into the loan amount. Okay, so that's the benefit for it. But coming back to the idea of the HARP program, I've had situations with people who have had a loan and they expected the value to come in at a certain amount. It didn't, and now they feel that they were unable to refinance their home. That's not necessarily true. The HARP program helps people in situations like that. It takes into consideration your credit. Although, based on an automated underwriting of it, it can actually come back that if your credit is a little less than expected, and I believe the threshold usually is around a 660, so the automated underwriting will determine based on that if the person is a good risk, especially since they have little or no equity in the property. So that is determined by working with a lender who has direct access to the HOP program. Many lenders do, and have direct access to an automated underwriting system where they could find out pretty quickly as to whether or not that person will get approved or if they're eligible for that program. Now, again, I gave you the website as far as where you can find out whether or not you are viable for that program. And the program itself actually deals with people who are primary residents, second home, and believe it or not, also deals with people who have investment properties, 1 to 4 families. So that's a great advantage. It also deals with the fact that you have to have at least 80% or more debt loan to value. And there's one other small piece of this pie that ends up being a snag when it comes to it. And I'm hoping at some point in time the government may address this because they've done a pretty good job with some other programs. If the loan itself was taken out on or before the end of May 2009, then you qualify for the program with either Fannie or Freddie. If the loan was taken out or taken out after, you do not qualify for the HOP program. So that is one of the little snags. So there's 3 major parts. Again, you basically have essentially 80% or more loan to value. And I've even had people who have had less than that qualify for it. Credit score of at least 660 or above. And then you also have to deal with the fact of a loan that's basically been taken out on or before the end of May 31st, I believe, 2009. So that's what you're dealing with right now. Now, there are many ways to basically get into the HOP program, but that website that I provided to you is very helpful because it'll tell you how you can be eligible, insight, information as to more about the HOP program. It'll also give you access to the direct links for Freddie Mac and Fannie Mae as to determine whether or not you are eligible. And it provides the ability of getting much more information as to what the program is about. Certainly, I'd be happy to answer any questions at any point in time and let you know if you're eligible. The website is just as helpful as well. And the 2 important parts of, again, this tonight, with the idea of letting you know more about credit reporting and how important it is that you know more about your credit report. Because, again, your credit report can be the difference between paying, an interest rate of, 3s or 4s or an interest rate in the 5s. Or, more importantly, not being eligible because of your credit. It also can help you as far as getting a job, because nowadays they will check your credit, determine whether or not you have the capability or they consider you responsible. And again, you need to know more about your financial standing from a credit standpoint, because not only would you be interested in buying a home, but if you needed to rent or you wanted to buy a car or even credit cards, the difference between a good credit score and a bad credit score is whether or not you can get credit, get a card, get a car, or get a home. So by all means, please do yourself a favor. Go to annualcreditreport.com. Have a credit pulled at least 1 time a year. My recommendation is twice to see exactly what's on your credit report. And if there are any blemishes, take care of them. And just have a clear communication with whoever the creditor is. Let them know your problems, your issues. Put it in writing if you have to, and find out what the turn time is for them to resolve it, especially if you're dealing with a collection. So 2 things you want to take out of this for tonight. 1, take control out of your own life, or of your own life and your destiny, because quite honestly, you are the only one determining whether or not you're going to succeed or not. And when it comes to finances, you are the one who controls that path. So pull that credit, get an idea of what stands in front of you as far as finances. And if you're in a home right now that's underwater, or you think it's underwater, you need to contact someone that you feel committed or dedicated to, someone that you know is going to take care of you. Again, it could be contacting me. It could be basically going online to basically the information at the makinghomeaffordable.gov. But it's very, very important that you basically create your own destiny by getting those key pieces of information for your credit and to find out about your finances. So next week, we're going to talk a little bit more about the industry and what things to expect for this 2013, because there's a lot of things in play. I mean, HOP program was put into play a couple years ago to help people who are up to 105%. There have been changes recently that are going to expand on that 105%, because there are people who are certainly underwater much more than 105%. So I hope to basically discuss some of those things next week and in the coming shows. And it's important to let you know that at any point in time, if you have questions, I want you to contact us, because quite honestly, this show is about two very important parts. One of them is to educate you as to your finances and how to make a better path for yourself so that you can get the things that you want, get a home, get a better car. So that's one of the reasons that I'm here. And the other thing is to basically talk to you about preparing yourself. Now, preparing yourself essentially not just for the financing part of it, but for life. Because if you have a family or you don't have a family, but you hope to have one, the idea is you need to basically be prepared for what to expect in the future, to have that home, buy that second home, get the investment property, put yourself in a better light, get the better car. So I want to make sure that you're in that better position. And the only way to do that is to ask the questions. Ask, Jeff, I'm in a position of this, I'm looking to buy a home, I'm looking to buy a car, what type of things do I need to deal with? I'll explain to you the process, I'll explain to you the pitfalls, and I'll explain to you what you need to do to put yourself in a better light and make a better life for yourself and for your family. So by all means, if there is any point in time you need to get in touch with me, my information will be on the screen and let you know exactly how to get in touch with me and what you need to do in order to get that better life. But take care of yourself and take care of the people who are around you, because you know what? Those are the people in life that are going to basically help you get through the tough times when you have it. And by all means, create that financial future that you want, because there's nobody else in this world that's going to basically create that future for you than you. So I hope by all means you have a good life.